UiPath just sent a pretty brutal message to the market. Most people have been looking at this company completely wrong. The real change isn't in the stock price, it's in the deep, structural shift happening inside the business. Hey everyone, this is Deep Dive Stock Earnings. When UiPath dropped this quarter's earnings, I'm being completely honest with you. My very first reaction was, this company has been undervalued for way too long. The stock jumping more than 10% after hours. It wasn't emotion. And it wasn't the market randomly getting excited. It was the numbers themselves breaking the old expectations. And I mean it. This wasn't a slightly better quarter. This was a full structural shift upward. Even I, after reading it, felt like this company is probably stepping into a brand new growth cycle. Let's talk about the numbers first, because this quarter's numbers really matter. UiPath delivered revenue of for $11 million this quarter, while Wall Street expected only $392 million. When you see that kind of gap, you know it's not a coincidence. Mint is pushing it up. EPS tells the same story. Expectations were $0.15, and UiPath delivered $0.16. It might look like just 1 extra cent, but in an environment with rising costs, heavier competition, and talent pressure, the ability to push profitability upward is not trivial. That means their business model is getting more efficient. Then let's talk about cash. They ended the quarter with around $1.5 billion in cash and short-term investments, more than last quarter. Free cash flow continued moving higher, and on top of that, they're still buying back shares. That move says a lot. Management would never keep buying back stock unless they're confident about the company's future. You don't drain your cash when you're uncertain. This clearly shows they're very sure about where the business is going. Now, after getting the numbers out of the way, we need to talk about one of the biggest misunderstandings people have about this company. A lot of people still think AI is going to make RPA obsolete, but that is completely backwards. If you've ever looked at how real companies operate internally, you know this viewpoint doesn't make sense at all. AI is great at thinking. It reasons, it analyzes, it judges situations, but the results are not always the same. You ask it something 10 times, you might get 10 slightly different answers. That's just how AI works. But RPA does the opposite. It needs to execute actions exactly the same way every single team. No deviation, no randomness, no surprises. In real enterprise workflows, inconsistency is the enemy. So AI makes decisions, and RPA executes them. These two don't replace each other, they're complementary. And the bigger the organization, the more obvious this becomes. UiPath sits exactly at the execution layer beneath AI. And look at their partner list this quarter. Microsoft, OpenAI, Google Gemini, NVIDIA, Snowflake. Tell me, do these companies partner with something that's going to be replaced? Of course not. You only partner with foundational infrastructure. UiPath is becoming part of the infrastructure of enterprise automation. Now we need to talk about the much bigger picture, and this is where UiPath's real opportunity lies. The penetration rate of enterprise automation is actually incredibly low today. Most companies aren't truly automated. They're just testing it in small pockets. Maybe the customer service team uses some automation. Maybe IT automates a few tasks. Maybe finance automates a small workflow. But this is nowhere close to true automation. Real automation is organization-wide automation. That means no matter which department, no matter which workflow, as long as there's repetition, clear steps, and predictable rules, AI handles the judgment and RPA handles the execution. That's the moment when UiPath's revenue curve will start bending upward. And this quarter's earnings are basically telling you that shift has started. Now, at this point you might be wondering, okay, what about the stock? Is the chart reflecting all this? Is the trend changing? And honestly, that's a really good question, because when I looked at UiPath's chart, I also noticed something pretty interesting. If you pull up the chart, you'll see that before earnings even came out, the stock had already started quietly pushing upward. It wasn't a sudden jump, it was slowly lifting, each pullback getting bought, and volume noticeably increasing. That is classic institutional behavior. They build positions slowly. They don't rush in on earnings day. And then on earnings day, after hours, you see that big upward gap. It breaks right through the resistance that held the stock for weeks. The gap was huge, not because of the size, but because it officially flipped the trend from sideways to upward acceleration. Look back over the last few months, every dip had buyers. You could see the accumulation, and this quarter's earnings basically unlocked all that bottom side positioning and shoved it above the trend line. This kind of setup usually leads into a brand new bullish phase. In simple terms, As long as the stock holds above that gap, the trend is solid. Because trends do not form out of thin air, they need fundamental drivers, and the earnings we just talked about, the partnerships, the cash strength, they're all pointing in the same direction. Demand over the next few quarters is real and sustainable. Alright, now we put everything together and say the one conclusion that actually matters. UiPath didn't just have a better quarter. It had a quarter where the company's entire growth engine shifted upward. Revenue strong, profitability stable, cash heavy, the partner ecosystem expanding, and enterprise automation finally moving from small experiments toward real adoption at scale. And the stock trend is reflecting the same story: breakout gap, stronger volume, rising support levels, everything lining up in the same direction. AI is not replacing RPA. AI is making RPA more essential. Companies don't choose one or the other. They need both to think, RPA to execute, and UiPath sits right at that intersection. If I had to summarize it in one sentence, I'd say this: this quarter wasn't a nice beat. It was the confirmation of a structural shift, a company stepping into a faster growth phase. This is Deep Dive Stock Earnings, and I'll see you in the next one.